Hi, welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford, one of the managing partners of a group called PassiveInvesting.com. And with me today is Ryan Webster and Warren Dresner. Warren, welcome to the podcast.
Thanks for having us.
Thanks, Dan.
I'm looking forward to diving into this asset, which is called Bradenton Reserve out of Bradenton, Florida. It was closed by your group in September 2021. We're actually recording this at the end of September of 2021. So just earlier this month. It's 166 units built in 1986, B-class asset. Before we dive into that particular asset, why don't you go ahead and tell us a little about yourself and your backgrounds and kind of where you are right now in the multifamily space?
Yeah, absolutely. Thanks, Dan. Prior to moving into multifamily acquisitions, I was on the other side of things in the construction development side. Owned and operated a construction development company for a little over 10 years. And it just transitioned into, acquisition of stabilized assets here within the last 18 to 24 months. Together with my partner, Warren here, we founded Equity Yield Group. And we focus really on, acquiring lower risk assets. Compared to what I was doing prior, we're building new assets, fighting your way through lease up, trying to prove out rents that may or may not exist in the market yet. It's really been a big shift into, stabilized assets that are cash flowing day one. And I didn't even realize this until we got into this side of things, but all of my debt had been recourse debt. And we started acquiring stabilized assets. Got to realize that, it doesn't have to be recourse. You can get non-recourse debt. So that was a big shift. So Warren and I have been working together about 18 months now. We've acquired 67 million worth of assets under management.
Awesome. That's exciting. Well, let's dive right into this particular acquisition that you guys had. So let's first talk about how did you find and how did you source this asset?
So I can answer that one. So this one was through a broker. We had actually transacted a deal through this broker previously. So we had a good relationship with them. They knew that we could close. So as soon as this one was coming out onto the market, we kind of pounced, spoke to the broker straight away. I went to tour the asset. And during that tour, we spoke about whether the seller might be interested in an early offer. So I think it was a Friday when I was touring. We got together over the weekend. We underwrote it pretty quickly. And on Monday, we submitted an offer. And fortunately, that offer was accepted.
That's pretty exciting. I know our group has done the same thing, trying to preempt some deals before it goes full market, because especially if you know a particular market and where properties have been going lately with going through the full market process, it's a great strategy to actually go in there and try to preempt it and try to pull it off the market before everybody else has a chance at the bite at a bite at the apple, if you will. So great strategy there. So with this prior relationship that you had with this broker, was it with a similar size project, or was this one a little bit bigger than the prior deals that you had done?
It was similar size. So the other asset was actually a little bit smaller. It was 148 units, but it was a Class A property. So it was, in terms of dollar value, it was kind of in the ballpark, very similar.
Okay. And what was the purchase price on this one in Bradenton?
This one was $30.25 million.
38.25.
30.25.
30.25. Okay. 30.25 million. And you were able to preempt it. When you submitted this preempt offer, did they basically just accept the first kind of preemptive offer, or did they kind of go back and forth to negotiate it with you just a little bit?
They actually just accepted it. So the guidance from the broker was pricing at least $30 million, 30. In our underwriting, we were comfortable with, we were familiar with the market, just like you mentioned, having owned the other asset down the road. We were comfortable submitting slightly higher than their asking price to try and encourage them to accept the offer. And in the end, they were happy to accept that price.
And with this particular broker, was it a normal or kind of like a regular kind of larger multifamily broker, or was it kind of a non-multifamily broker?
It was a regular multifamily broker, kind of a niche Florida broker.
Sure.
But they specialize in larger multifamily and newer products actually as well.
Okay, good. And with this particular property that you put this preemptive offer on, did you actually get to tour it before you put the offer on it, or did you kind of already know about the asset, just try to put the offer on there to preempt it first?
No, we did get a chance to tour it.
Okay, so you're able to go down to the property, give it a nice tour. Where are both of you located, just so the listeners know, as far as location wise from this property?
So I'm based in South Florida. I live in Miami, so it's about 3 hours to Bradenton.
I'm up in the Midwest here in Cedar Rapids, Iowa.
Now, did both of you go look at the property, or did you, Ryan, say, Warren, you go look at it first, and if it's a good deal, we'll consider it?
Yeah, usually Warren's a little closer. So he gets the first look, and then I get down there during due diligence and check-ins after that.
Yeah, that's a good process to have, so you're not wasting too many people's time, and you can focus on maybe looking for the next asset and various things like that. Because if you did that on every asset, it would be very hard to find properties in this particular market because of how much you'd be going around trying to look at property. So it's great to be able to kind of divide and conquer when you have two partners like that in a partnership. So good there. Next question I have for you is, walk me through kind of the terms of the offer, as far as how much time did you put in for the initial due diligence and time to close, and were there any extensions, and then also walking through the earnest money on this one.
Sure, I can do that as well. So the original offer had 21 days due diligence period, slightly shorter than usual, which is something we often do to try and make the terms a bit more attractive for the seller. Being a smaller asset, we were comfortable that we could get through the due diligence in that time period anyway. It was 60 days to close. And from an earnest money perspective, we had $450,000 up front with a further $400,000 after the due diligence period.
Any extensions?
There was an extension which we negotiated. I think it was 20 days.
Yeah.
We didn't end up using it, but we had a 20-day extension in there.
Okay, so total of a 81-day close on the initial part of it, and then an option to extend for another 20 days if needed.
Actually, no. The 21-day DD was within the 60, so it was a 60-day from PSA to closing.
Okay, so it was 21 days due diligence, 39 days to close after that.
Absolutely.
Yep.
Perfect. I thought that was a little bit long, but hey, you never know in this market how things happen. So 21 days due diligence, 39 days to close, option for another 20-day extension. Was there additional earnest money that you had to put up? I'm not sure if you mentioned that or not, if you had to extend.
I believe it was $100,000 additional earnest money.
Okay. And of the 450,000 that was initial, how much of that was hard day one? Was all of it hard day one, or was it only after DD?
All of it was hard day one.
Okay. And what kind of exclusions did you include in that initial earnest money deposit as far as contingencies? Because I know there's always some, title, phase one, survey, things like that.
Yeah, it was those standard carve-outs.
Okay, so this is just standard carve-outs, nothing no kind of special there. Great. And then let's kind of talk about due diligence. So you've now got this deal under contract. PSA has been inked. Now we're in that 21-day due diligence period. Anything that kind of came up during that due diligence period that might be interesting to talk about?
Actually, it's a remarkably smooth transaction. The sellers were great to work with. Due diligence went super smooth. There wasn't really anything that we weren't already expecting. Got a good look at things initially, and just kind of knowing the vintage of the property. There's the usual kind of repair items. We knew the roofs were getting to about that time. Usually have HVAC units that they're going to go out here and there on this vintage. We did find one sewer break, but luckily that was in an easily accessible location. It wasn't under the pavement or anything, so that ended up being a cheap repair. So that was really about it as far as due diligence went. Super good. The lease audit was very clean. Some of the tenants we had, up to 5x income to rent. So we've had this, already where some of the existing tenants are looking to move into renovated units and stay on the property, which is always nice when you're doing a value add. If you have the income coverage for the renovated rents, you don't have to go find new tenants. You can keep the ones you have that and have a relationship with.
And with the some of the typical repairs that you might have saw during the due diligence period, did the lender require you to hold that for them to hold back any reserves to pay for some of that, or was it just pretty standard stuff and they weren't really concerned about it?
Yeah, actually, the PSA didn't flag anything on the property. We flagged a lot more items that were of concern to us than were concern of the lender, which was kind of surprising. But it allowed us to reduce, the replacement reserves down, which is always nice.
Sure. No, that's definitely good. Next question I have for you is about the kind of overall business plan. Obviously, this is a 1986 asset. When was it last renovated? What do you guys plan on doing? Are you planning on doing some renovations? I'm assuming you probably are with that kind of a vintage, unless it's already been renovated. But walk us through kind of the overall business plan that you have on this particular asset.
Yeah, so it's a value add plan. There's some renovations that have been done on the property. Previously, there's about 3 different scopes, from what they were calling a premium unit to completely classic. We're planning to bring all the units to a uniform scope, very similar to a scope we did down the road at our other property, which is about 10 minutes away, which has seen really good response with new leases, which basically consists of, putting in granite countertops, tile backsplash, replacing the cabinet fronts, and updating paint colors. It's really about all that's going to happen on the interiors. And the other play is we're putting the property on revenue management software, which we also did on our other property. This was one of 2 properties in the pocket that was not running revenue management software. And in this market, which currently is very supply constrained as far as housing goes, rents have been going up quite a bit, even within the last 6 months. So that was one of the things that was holding back rents on this property. So the average contract rents, when we took it over for like a 1-bed, was $1036. Our targeted renovated rents for a 1-bed on average were $1373, and that's still $100 under kind of the comp set there. So we're not trying to jump up to the top. We kind of like the middle to the bottom of the upper quadrant. Back to my years on the development side, I don't like to be the guy at the top of the comp set.
What's the unit mix?
1s and 2s.
And as far as the cost that you have set aside for the interior renovations, you mentioned granite, tile, paint. What's kind of the overall budget that you set aside for those interior renovations?
So interior renovations, we got about 1.1 million.
Mm-hmm.
And because we have, varying level of scopes, I think our cheapest unit interior was about 2,200. And that one was pretty much just countertops and tile backsplash, because a lot of the other work had already been done.
Mm-hmm. So roughly about $6,600 per unit, obviously changing based on the different renovation scopes that have already been done.
Yep.
What about appliances? Any appliances need to be replaced? Maybe on the classics or something?
We're adding microwaves. That seems to be the thing in this vintage, and even some of the newer properties we're seeing. There's just not microwaves, and that's something that the tenants seem to like. So we're replacing the cabinet above the microwave to allow for clearance from the stove to the microwave. But yeah, a lot of the previously renovated units already have stainless steel appliances. So we're just adding a microwave to match the packages there.
Now, as far as interiors, we got $6,600 per unit. What about the exterior? Any plans for doing anything on the exterior?
Yeah, we're going to take care of some roofs. This was one of the things, and it was interesting to see in due diligence going through the historical maintenance tickets. They didn't spend $1 they didn't have to spend. They did a very good job of patching roof leaks immediately, and they had quite a few of them, but they got somebody out to fix them right away and avoided any damage or moisture within the structure, which is great. But they probably should have been replaced a couple of years ago.
Mm-hmm.
So we'll be taking care of some of the roofs. The sewer break, we're taking care of that. There's some minor electrical repairs, and then some general kind of cleanup around the landscape. And then we've got some screened-in patios, which are very popular in Florida. That need some minor repairs and cleanup.
And what was the overall budget for the exterior?
Exterior, we're looking at $792K.
So roughly about $800K on that. Good. And it's, as far as the revenue management software that you had mentioned earlier that you guys are going to be implementing, or I'm assuming by now have already implemented on this particular property, what were they using before?
They were just pricing it manually, kind of looking at the comps, but they bought this, at a time when it was a totally different market in this pocket, and their business plan really wasn't around, pushing rents. It was around maintaining occupancy and not really spending any more than they had to on repairs.
So they were still using some sort of like property management software. They just weren't using a like daily repricing tool. Is that correct?
My understanding was the property manager would go out quarterly and just do a comp survey manually, and then kind of compare and contrast what they could get and test out some leases.
Mm-hmm. Yeah, quarterly is definitely not fast enough,
especially in a market. Yeah, absolutely.
That's crazy. So let's talk about the financing. Let's move into that for just a little bit here and talk a little bit about what you guys did from a financing perspective.
Yeah, absolutely. So we went with a bridge loan, so we could get the CapEx future funded in the loan. So we got a loan from Bridge Investment Group. And it's actually interesting. So Bridge Investment Group, a very large group, and they buy a lot of the B piece of agency debt. And they have apparently a lot of pieces of debt down in that market, and we're quite familiar with it. So they were one of 3 or 4 term sheets that came back, and they said, we like this deal. We're familiar with the pocket. We see a lot of appraisals of properties in the area. We like the value, so we want to finance this deal for you. So they gave some pretty attractive debt. They came up to 77.5% loan to cost, 3+1+1, no exit fees, a variable rate. It was 3.37 at close. So it was 335 over LIBOR. And then we bought, a very aggressive rate cap to essentially buy ourselves a fixed rate loan.
Mm-hmm. That's good. That's a pretty typical 77% LTC, 311, no exit, 3.37%, 33.35 over LIBOR. Now, are they going to eventually going into kind of the SOFR, or are they going to stay on LIBOR during this whole period?
No, they're staying on LIBOR, which I found interesting because the other loan was SOFR, and you're seeing kind of a mix, and it's lender by lender now. But I think it's kind of like the metric system. They've been telling us for 50 years they were going to convert, and it never happened. So we'll see if all the lenders convert or not.
Yeah. We've kind of seen the same thing. Kind of just depends on the lender. What kind of prepayment penalties on this?
Just your standard defeasance. There's no yield maintenance.
Okay. Any lockout period or anything?
12 months.
12 months, standard 12 months. Okay. Good. And so what was the total equity check that you had to bring to the table on closing on this one, including all the closing costs and things like that?
Yeah. So we're 8.9 million in equity.
And how did you go about raising that money?
We syndicated it from a network of investors, raised it in a little under 3 weeks. I think, so I recall our average investment was $95K.
That's good. So how many investors did you end up having on this one?
I'm not sure off the top of my head. Warren?
Yeah, it's a little over 100, maybe 106 or 108 investors.
Okay, good. That's awesome. Let me see here. How did you end up structuring the deal with your investors?
We like to keep it pretty simple. It's just an 8 pref and a 70-30 split.
No performance hurdles or anything like that?
Nope.
And is it a true pref or is it a pari pursue pref?
It's a true pref.
Okay, good. That's what I like to see. It's always nice. That's good. And so I'm going to ask you a question here, because I know we've covered quite a bit already during the episode right now, but can you think of anything that we have not covered yet that might be interesting to talk about this particular acquisition?
Yeah, I think it's noteworthy talking about the market conditions. And the thing that really sold us on the asset was having the other property down the road, and seeing the factors in the market that were driving performance on that particular asset. So on that one, we're outperforming pro forma by 20% already. And one of the things that kind of happened during COVID, and you see this in some of the more growth markets, development projects kind of hit the pause button. It was hard to secure financing at the onset of COVID. And there's a lot of hoops you got to jump through, getting them permitted and getting them up and out of the ground. And then this is a market where a lot of people are moving. I think it's still like number 2 moving destination in the country right now. But they weren't building new housing, and they had been for the past 5 to 10 years, just building and building and building and building. But that stopped in the last 12 months. But people kept moving. So people don't have anywhere to live. And we have people coming in at this property and our other property, and just signing a lease because they have jobs and they have a start date that they need to start their job, and they don't have a place to live yet. So anyone that has any sort of availability, people are rushing in to sign leases. And that's our biggest challenge, is getting vacant units to renovate, just because the occupancy is so high and the vacancy is so tight. And because of that, you're seeing just huge rent growth in the area. And it's just all, macroeconomic supply and demand.
Yeah.
There's an article in the local newspaper actually quoted year to date rent increases in Manatee County of 31%, which is incredible in 9 months.
Well, that's definitely great. That's definitely good. Especially when you're buying a property from somebody who didn't keep up with those increases like that. I mean, that's definitely a good kind of meat on the bone type of property.
Absolutely.
Well, Warren, Ryan, thank you so much for being here on the podcast. It has been a pleasure having you on and walking through this property that you acquired earlier this month. How can the listeners reach out to you if they have further questions for you about this acquisition, or if they just want to follow you more?
Yeah, absolutely. Check us out at our website at equityyieldgroup.com.
Awesome. That sounds great. So equityyieldgroup.com. And again, thank you so much, gentlemen, for being here and sharing all these golden nuggets throughout this episode. Looking forward to continuing to follow your group as you continue to close more deals, and looking forward to having you on a future episode as well.
Thanks, Dan. Thanks for having us.
Thank you, Dan.